With Trump's tariffs, the rising national debts, and the undergoing shuffles in the world economic order, a recession or at least an economic slowdown is quite imminent.
And it was serious before the last election. We have a huge, complex geopolitical situation, huge fiscal deficits, not just here, but around the world, sticky inflation, which I personally think will not go away so quick. And then you have, what's going to happen with tariffs, what's going to happen with trade, what's going to happen. So
I think it's likely that we're not going to be in a recession.
I'm going to say something that might sound a little crazy. Imagine if I told you that we might be some of the luckiest people on the earth right now as we are heading towards a recession. So I know that a recession sounds scary, but with some planning, patience, and knowledge, it can be a great time to invest in the stock market and earn some handsome cash. So stick with me in this video, and by the end, you will understand why recession or a market crash is one of the best times to invest in stocks. And second is my simple strategy during these periods of recession or economic turmoil. History has shown us that tough economic times can create huge opportunities for investors. Let's get back to one of the scariest moments in the stock market history, the 2008 financial crisis. People were losing their jobs, homes, and their life savings, and the stock market plummeted to record lows. Now, what if I told you that this moment of extreme fear was one of the greatest buying opportunities of our lifetime? Let's do a little what if. What if during the worst part of the crisis, that is March 9th, 2009, you had taken $10,000 and invested in the S&P 500. The S&P 500 closed at approximately 676 on this day. Fast forward April 1st, 2025, the S&P 500 is somewhere at 5,633. Hence, you would have achieved 5633 minus 676 divided by 676 into 100, that is 733.284% gain. This means your $10,000 investment would have turned to $83,028.4 in some 16 years time. So that's not bad, right? And remember, this is when you invested only once and left without any additional investments all through these years. Also, when you check the growth of your investment a decade later, in March of 2019, when the S&P 500 was 2,743, you could have got somewhere around $40,000, which is 4 times your investment. And it's not just history that gives us a clue here. Even the world's most celebrated investor, Mr. Warren Buffett, is signaling a similar strategy. Warren Buffett's company, Berkshire Hathaway, is currently sitting on a record pile of cash. This isn't pocket change that we are talking about. Berkshire Hathaway's cash holdings are more than the combined cash of some of the biggest companies in the world, including Apple and Microsoft. So the billion-dollar question is that why is Mr. Warren Buffett holding so much of cash? It is because one of his fundamental principles of investing, which says, be fearful when others are greedy and be greedy only when others are fearful. This means Warren Buffett thinks that people are greedy nowadays and currently stocks are overvalued. Value investors like Warren Buffett often use some ratios which indicate whether the market is under or overvalued. One of these ratios is the price to earning ratio, or the PE ratio. This ratio basically tells you how much investors are willing to pay for each dollar of the company's earnings. So higher the ratio is, higher is the stock of the company valued. And right now, if you see, this P ratio is way above its historical median of approximately 17. It suggests that the stocks are significantly overvalued. This explains why Warren Buffett is keeping a large pile of cash. This is because he sees a looming recession when the price of these overvalued stocks will fall. Then he plans to buy them at lower prices. Hence, you can see that it is not only the history, but value investors like Warren Buffett also who follow the strategy of investing heavily during times of recession or economic turmoils. Now, I am no Warren Buffett, nor do I have a large pile of cash. I cannot even time the market to know when will it hit the bottom. In fact, you know that even Warren Buffett, or anyone for that matter, cannot predict the market.
One rule of Wall Street: nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
Hence, I rely on the following simple strategy. If I talk about my strategy is not only to earn good profits by investing in a recession, but also to save myself from the brand. What do I mean? I mean that before even thinking of investing, there are few things that I need to prioritize. The first is emergency savings. This is absolutely critical. If you do not have funds for times of crisis, then this should be your first priority. I would say have at least 6 months of emergency fund for probable job losses, salary cut, and God knows what more. After emergency funds, the second prioritization is to pay your high cost debts. If you have a debt, especially credit card debts with high interest rates, paying that off might be a smarter move than investing. The interest that you're paying on that debt could be more than the profits you're making from the stock market. And it is most likely that the interest that you're paying on your credit card debt might increase at the times of recession. And the third prioritization after having an emergency fund and paying your high interest debt is to inhibit yourself from spending on leisure items like clothes, branded watches, or something. I know this sounds depressive, but remember, we are preparing for the rainy day. And we also need cash to invest when the opportunity comes. So we need to stop ourselves from spending on unnecessary items for some time at least, like branded watches, clothes, and unnecessary vacations. Remember, we need cash for our emergency funds, and also we need cash, ready cash, to invest when the opportunity comes. So this is my third strategy, wherein I am inhibiting myself from spending on unnecessary items. Now that I have taken all the precautionary measures, I can now invest in the stock market or plan or strategize on how to invest in the stock market during these recessionary periods. But again, the question remains as to how to time the market. So, see, the answer is that we do not have to time the market. We would use an investment strategy called the dollar cost averaging, DCA, dollar cost averaging. So, under the dollar cost averaging, I will invest a fixed amount of money regularly, like monthly in my case, as the stocks will fall, as the price of the stocks fall. So, for example, depending on the pile of cash that I have, and regardless of the stock price, I can invest, let's say, $1,000 monthly or $1,000 every 45 days as the price of the stocks fall. But here I add a tactical layer. If I will see the market falls, let's say by more than 10%, then I will increase my investment for the month. Again, the increase is not very stringent and it depends on my cash availability in the month. I'm taking the example of S&P 500 because I invest in that only. But a similar strategy can be applied in other indices or stocks you invest into. This strategy lets me consistently buy into the market while taking advantage of price drops. I buy more shares when they are cheaper. It also removes the stress of trying to perfectly time the bottom, which is nearly impossible. If you like this video, please share and comment and subscribe to my channel.